There is an so this is an intangible factor. We know that the management is something which is like consisting of the science and art both. So how is the management of the company, what kind of the past that it has, whether it has say any like bad intentions, or it has say some like the bad news about the management or not. We have to see that say what is the time period over which so the management is say, operating. Yet it is very important bearing on the value of the shares. So again we have to see that say this is from the investor point of view. So from investor point of view we have to see that say how is the quality of the management. If the quality of the management is good for long period, then in that case of course the security is worth buying. Every investment manager knows that the shares of certain business houses command a certain premium than those of the similar companies managed by other business houses. This is because of the quality of the management. The confidence that the investors have in a particular business house, its policy, vis-a-vis its relationship with the investors, dividend, and the financial performance record of other companies in the same group. So again, we will make a comparison of this company say with the peer group. This is perhaps the reason that an investment manager always gives a close look to the management of the company in whose shares he is supposed to invest. Quality of the management has to be seen with reference to experience that they have for doing business, skill that they have for doing business and for management also, integrity, that is the honesty that they keep of the person at the helm of the affairs of the company. The policy of the management regarding the relationship with the shareholders is an important factor since certain business houses believe in very generous dividend and the bonus distribution. So, what kind of belief or what kind of principles that say they follow for the purpose of distribution, while others are rather very conservative. However, an average investor is at disadvantage when compared with a large investor. They do not get the facility to meet the top executives of the company, but the fund manager interested in the investing huge amount of the money generally get to meet the top brasses of the organization. So basically, this statement says that say when it comes to the mutual fund, when it comes to the insurance company, they get say an advantage, or they have an opportunity to meet with the top management of the company, and with that say they can take a decision regarding the investment. So they can have say the understanding of the future plan, and based on that say they can take a call that whether to make investment or not. However, the small investor is definitely not able to say get such opportunity. It is true that every listed company give a detailed information about its management, but the information they give is always positive. This is because no company will host any negative information about the company. So definitely the company will from its own side will give the information which is either positive or will not speak anything so regarding an issue so which is negative for the company. So the question is to how to find the dirt inside the management. The remedy is to look out for the conferences calls hosted by the company's CEO and CFO. After reading the company's financial results, they take question and answer sessions from the investor. That's where one can pick something that indicate about the true position of the company. So what happens at say whatever the press conferences that say they attend after the meeting, so that will give an idea to you that say what may be the poor side or the dark side of the management. Some other ways to judge the management of the company is to read out the management discussion and analysis report. Further, it helps with when the top management people are also the shareholders. If the large scale unloading of their shares are taking place, this is very important because what you speak is not so important than what you do. So what you are doing, if at all you unload your shares, if at all you sell your investment, that may be one of the indicator that so you are not very confident say for doing business, and something else is communicated to the media, then it is a sign of something is wrong. Another way to judge the effectiveness of the management is to see past performance of the executive, say for 5 years. Then corporate governance. Following factors are to be kept in mind while judging the effectiveness of the corporate governance of the organization. There are four factors that say they have provided. Whether company is complying with all aspects of SEBI, that is listing the requirements, how well corporate governance policy serve the stakeholders, quality and the timeliness of the company's financial disclosures, whether quality of the independent directors are inducted. So these are the things so that will be considered. Regulation. Regulations play an important role in maintaining sensitivity of corporate form of the organization. In Indian listed companies, Companies Act, Security Contract and the Regulation Act, SEBI Act basically look after regularity aspect of the company. A listed company is also continuously monitored by SEBI, which through its guidelines and regulations protect the interest of the investors. So basically, these government organizations will make sure that the funds of the investors say are properly protected and the companies are not making any misuse of the same. We know that the mutual fund is also say regulated by SEBI, wherein so the mutual funds are also required to give the regular disclosures. They are required to keep the expense ratio within certain limits. They are required to make the investment as per the commitment that say they have given. Large cap, mid cap, small cap, diversified, any sectorial investments, whatever the commitment that say they have given to the investors, as per those commitment, the investments are supposed to be made. Further, a company which is dealing in the companies outside India needs to comply with FEMA. In this scenario, Reserve Bank of India does a continuous monitoring. Location and labor management relationship. The locations of the company's manufacturing facilities determine the economic viability, which depends upon the availability of the crucial input like power, skilled labor, raw material, and so on. Nevertheless, to markets, nearness to the market is a factor to be considered. So we know that the number of the organizations which have been organized near port are the reason that they are able to ship their goods easily if at all they have the good amount of the export business. So where is the business located in which you are going to make investment is also important. In past few years, investment manager has begun looking into the state of the labor management relationship in the company under consideration and area where it is located. Uh, we have understood something like called unsystematic risk. In that say we have covered one point as the relationship of the management with the laborers. If at all that relationship is strong, then in that case it is considered to be like a good point of the company, and if it is not good, then in that case it is the unsystematic risk, and we should not select that kind of company for investment. That is what the kind of point that we discuss. Pattern of existing stock holding. More the promoters share, it is a good sign, and vice versa. An analysis of the pattern of the existing stock holding of the company would also be relevant. This would show the state of various parties to the company. An interesting case in this regard is that Punjab National Bank, in which Life Insurance Corporation and other financial institutions had substantial holding. When the bank was nationalized, the residual company proposed a scheme whereby those shareholders who wished to opt out could receive a certain amount as compensation in cash. It was only at the instance and bargaining strength of institutional investors that the compensation offered to the shareholders who wished to opt out of the company was raised considerably. Next is the marketability, that is the liquidity. We understand that the higher the liquidity, better the liquidity is what required from the investor point of view. If at all the liquidity is more, then in that case as an investor, I will be having a kind of security that say whenever I want to exit, I will be able to exit. Another important consideration for an investment manager is marketability of the shares of the company. Mere listing, that is only listing of the share on the stock exchange, does not automatically mean that the share can be sold or purchased at will. This is very important, friends. This says that say whenever you are listed, it does not mean that say your share will be traded say at a like high scale only. There are definitely chances that say the security may not be say properly traded in the market. Why? Because say it may be the B or C category shares. Only for the blue chip companies, say we will be able to see that say there is a good amount of the trade. There are many shares which remain inactive. That's very true. We know that it is penny stock in which we have something like this for long period with no transactions being affected. To purchase or sell such script at difficult task. In this regard, dispersal of the shareholding with special reference to the extent of the public holding should be seen. The other relevant factors are speculative interest in the particular script, the particular stock exchange where it is traded, and the volume of the trading. Techniques used in company analysis. Through the use of the statistical techniques, the company wide factors can be analyzed. Some of the techniques are discussed as under. So, information is provided about certain techniques. The first is the correlation and a regression analysis. Second is trend analysis. And the third is decision tree analysis. Though that is through the use of the statistical techniques, the company-wide factors can be analyzed. Some of the techniques are like this. First, correlation coefficient. Simple regression is used with interrelationship covers two variables. Friends, we understand that so the correlation coefficient can be found between any two variables. Returns of like TCS and the returns of Infosys. Returns of let us say HDFC Bank and returns of Reliance Company. We understand that so the correlation coefficient between like advertisement expenses and sales of the company. So there are a number of factors between which say you can measure the relationship. For more than two variables, multiple regression analysis is followed. Means what will be the effect of two or three variables on one variable? That is what we understand is the regression analysis. Here the interrelationship between the variables belonging to economy, industry, company are found. The main advantage in such analysis is the determination of the forecasted values along with the testing the reliability of the estimate. So we can say something like this. That's what will be the kind of profit of the company, or what will be the sales of the company, what will be the financial performance. For that say we can take into account certain factors that say what is the overall situation of the economy, what is the overall situation of the industry, what is the overall situation of say other like the group of the companies. All those things say can be established and we can build the relationship. Means when the GNP was, that is the gross domestic production was 5%, this was the profit of the company. 8%, this was the profit of the company. Negative 3%, this was the profit of the company. So you can have a relationship that say for different gross domestic production, what will be the profit of the company? What will be the performance of the company? That is the way you can have the correlation regression analysis. Trend analysis. The relationship between one variable is tested over time using regression analysis. It gives an insight to the historical behavior of the variable. Means we can say something like this. Suppose the sales of the company is 2 lakhs, then 2 lakh 50,000, 1 lakh 50,000, 3 lakhs, 5 lakhs. In the trend analysis, what happens at say for the base year, we take the value 100. Then what happens at 250 divided by 2 lakhs into 100? That comes to 125. 150 divided by 2 lakhs into 100. That comes to 75. 3 lakhs divided by 2 lakhs into 100. That comes to 150. 5 lakh divided by 2 lakh into 100. That comes to 250. This is the trend analysis, wherein we have taken this as a base year. So taking that as a base year, say the trend is going up, then again going down, going up, and further going up, something like that. Otherwise, you can also change the base year, that is 100, 125. Then taking this 2,50,000 as a base, so you can make this calculation. That is also the way you can do the trend analysis. Decision tree analysis. Friends, decision tree analysis is an operational research concept. I just give you some explanation for the decision tree analysis. In that, say, a diagram is drawn for the purpose of understanding that, say, how the project is going to build upon. Let us say that, say, we have to take a decision regarding installation of a plant and machinery. So basically we are required to take a decision whether to install the plant or not. So install, do not install. If you do not install, the project is over. If you install, then in that case you have to take a decision whether to install large plant or to install small plant. If you install large plant, then in that case, what will be the sales of the company? For that, say you are uncertain. So that is indicated by way of a node. Node is like indicating that at this point of time you are not sure what will be the outcome. The sales of the company may be high, sales of the company may be low. The chances are 70%, 30%. If at all the sales of the company is high, then in that case the revenue of the company will be, let us say, an amount of 5 lakhs per annum for 5 years. Over here it will be 2 lakhs per annum for 5 years, something like that. So you will assign probability for the different outcomes set a specific node. If it is like you install small plant, then in that case again you will be having one of the two outcome. Demand may be high, demand may be low. For that, so the probability will be provided to us. And in that period, that is, say, in that outcome, what will be the cash flows that will be given? Let us say the cash flows will be 3 lakhs and over here 1 lakh. Now, if at all the demand is high, then in that case, listen carefully what I am going to speak. In that case, you are required to take a decision once again. What kind of decision? That say whether you should expand or not. Okay, if at all you install the large plant, you may have to make investment of 6 lakhs rupees. In case of small plant, you are required to make investment of, let us say, 3 lakhs of rupees. That is the way the investment is supposed to be made. If at all you expand, that is, you have to take a decision. That's whether you should expand your small plant into large plant or not, or do not expand. In both the cases, what is going to happen? For that, say, we will be provided with some information, and say whatever the outcome, to that, say, again the probability will be assigned. Then maybe the multiple outcomes possible. This is very similar to, say, if you remember, there is a concept called risk analysis in capital budgeting. With that concept, this entire decision tree analysis is there. So we have something like called D1 decision at 1, D2 decision at 2, D3 decision at 3. The cash flows will be provided along with the probability. Cash flows, probability, cash flows, probability, cash flows, probability. That will be provided to us. Then we will give the numbering to the node. That is 1, 2, 3, 4, something like that. Then the future cash flows will be discounted in the present value term. And based on that, say, you are required to take a decision. This is what, say, basically we have a concept called decision tree analysis. This is more applicable in case of like that is, it uses, so the concept of the operational research. That is what we have. So let us keep this in mind while reading this entire information. Information relating to the probability of the occurrence of the forecasted value is considered useful. So probability is supposed to be assigned. A range of the values of the variable with the probabilities of the occurrence of each value is taken up. The limitations are reduced through decision tree analysis and use simulation technique. So friends, there is another technique also called simulation technique, which can be applied for the purpose of decision making. Once again, it is like the operational research technique that we have. In the, that is, say, the simulation, that is, say, the technique we have something like called random number table. Random number table is something like this. I just give you some that is explanation. Let us say that, so you are considering to make investment in a stock. So there are 30% chances that the dividend per share will be 20 rupees. 50% chances dividend per share will be 30 rupees, and 20% chances dividend per share will be 50 rupees. Okay. Again, the probability will be provided to us for market price of the share. 10% chances price will be 200, 60% chances price will be 300, and 30% chances price will be 400. So the probabilities will be assigned for the different dividend, and probabilities will be assigned to the different price. Now, in case of the simulation analysis, what happens, friends? We create different situations from the given information, and so those situations will be created using a table called random number table. We have heard about the present value table, we have heard about the T distribution table, we have heard something about Z table. Similarly, we have a concept called random number table. In decision tree analysis, the decision is taken sequentially. Okay, sequentially means that, say, you will take decision one by one with the probabilities attached to each sequence. To obtain the probability of the final outcome, various sequential decisions given along probabilities, the probability of the each sequence is to be multiplied and then summed up. I can say something like this. The statement says that what happens that, say, you are required to, there is a concept that we have called joint probability. There is a concept called joint probability. The joint probability concept works like this. That say what is the probability that the dividend will be 20 and market price will be 200. For that the joint probability is 0.3 into zero point 0.1, that is 0.03. That dividend will be 20 and market price will be 200. What is the probability that the dividend is 20 and market price is 300? It is 0.3 into zero point 0.6, that is 0.18. So it is 20 and 300, that comes to 320. What is the probability that the dividend will be 20 and market price will be 400? That is 0.3 into zero point 0.3, that is 0.09. That comes to 420. This is the way we assign the joint probability for the different situations. Then we make summation of them. And friends, the total of them will be definitely 1. And of course, you can understand over here logically, there will be total 9 situations. Okay, let us say it is A, B, C. This is X, Y, Z. So AX, AY, AZ, BX, BY, BZ, CX, CY, CZ. So total 9 situations will be there. And for that the joint probability can be calculated. And this is what they have provided over here. The fundamental analysis is basically an examination of the economic and the financial aspects of the company with the aim of estimating future earning and the dividend prospects. It includes an analysis of the macroeconomic and political factors. Macroeconomic means systematic risk factors, which will have an impact, that is huge impact, on the performance of the company. After having analyzed all the relevant information about the company and its relative strength vis-a-vis other companies in the industry, the investor is expected to decide whether he should buy or sell the shares. That is what we understand. Apart from this, group analysis has also become an important factor. SEBI in particular emphasizes the need for disclosure, public of a document, all relevant parameters, especially the financial health and the promise versus the performance of the group companies. Friends, I do not know, but you might have gone through red-handed prospects of any of the company which is coming with IPO. If at all you read that red-handed prospects, then in that case you will find that the company is required to give too much detailed information about the company's own financial records and at the same time its comparison with the peer companies. That is what they have referred over here. Reserve Bank of India has also been focusing more and more on the group exposure norms of the commercial bank. This is what we understand. So decision tree, and in this simulation only the name is given, nothing is more than that. This is what's the fundamental analysis. So just having overview of the fundamental analysis. So basically, starting of the chapter says that there are two types of analysis: fundamental, technical. Fundamental, you just keep in your mind that we compute the equilibrium price of the security with certain quantifiable measures. That is fundamental. In fundamental, three things that you have to remember definitely. One is economic, that is whether to invest in the US market or not, whether to invest in the German market or not. That is the economy analysis. Second is the industry, whether to make investment in the banking industry or not, whether to make investment in PSU sector or not, whether to invest in the pharma sector or not, something like that. And the last is what we understand is the company analysis. So this is what the price, what they want to. Economic, that is everything that they have divided into two parts. One is the factor and another is the techniques to measure it. So the factors for economic analysis, there are 4 factors: growth rate of the national income and related measures, growth rate of the industrial sector, inflation and monsoon. Techniques in that anticipatory survey, barometer or indicator approach, economic model building. These are the three things. So I would say that so the economic analysis is not very like big. It's very simple. Industry analysis. In that again two things: factors and techniques. Product life cycle, demand supply gap, barriers to the entry, government attitude, state of the competition, cost condition, profitability, technology research. Techniques. There are two techniques: regression and input output. Company analysis. That's like absolutely like it is a big list that we have. Net worth, sources and uses, cross sectional time series analysis, size and ranking, growth record, financial analysis, competitive advantage, quality of the management, corporate governance, regulation, location and the labor management relationship, pattern of existing stock holding, marketability. So 13 points are there. Techniques are very less, only three are trend, decision tree, and simulation, because simulation is a separate technique. It is not the part of the decision tree. In that say, I have explained you something like called we have random number table.